Let's take a quick look at our markets. In the first hour of trading following the release of the June inflation report, we've come in at 1.4%, a tad faster than the previous month. The Philippine Stock Exchange Index is trading this Friday nearly flat. As you can see, they're barely budging, 6,469. PSEI has gained yesterday, Thursday, by 0.7%, and the broader All Shares Index ticked up by 0.1%. Trading was still strong as total value turnover surged to 10.23 billion pesos. Local counters were up, except for industrial and services sectors. Meanwhile, the Philippine peso today opens weaker, 56.40 to the dollar. The peso closed yesterday stronger at 56.25 against the greenback. For quick reaction and analysis, we're joined by Joseph Garcia, managing partner of Grow Capital Partners, a boutique financial and investment advisory firm providing strategic advice and investment solutions. So good to see you again. PJ, welcome to the program.
Yes. Thanks, Kathy, for having me.
Yeah, so what do you make of that? 1.4% for June.
It's actually very good. I think that's, as you mentioned, slightly below market consensus. And I think, again, way below the 2 to 2.5% guidance of the BSP's inflation target for the year. So that means that policy is working. That means their policy stance over the past 24 months have worked, and that there's more likely a path to a further rate cut or a more accommodative monetary policy stance from the BSP over the next 6 months.
But is policy working for the consumer? Because as you've heard from Merimon Reyes, people still feel the pinch of 1.4% as something very difficult for their purchasing powers. And we're coming all the way from 3.7% last June. They're still feeling the crunch. It should have made a difference.
Yes, surprisingly, there's been, I would say, a bit of some rough patch in the economy right now. And we saw the first quarter GDP numbers. Consumption was a tad lower than expected, given that in May or in the second quarter we had actually election spending. And I've been talking to some industry experts, for example, or in the F&B industry, and they all said that first quarter was really below their expectations for this year. And they're hoping that in the second quarter, and we just ended the second quarter like a couple of days ago, hopefully that would recover given the election-related spending in May. Again, that remains to be seen. But there seems to be a consensus that the first quarter, or at least the first half of the year, was a bit more on the weak side compared to what economists and analysts were expecting.
And what do you think? Might that trend continue, given that we've had the escalations in geopolitics in the Middle East? And a rollback of fuel after a week's increase in prices. Just see how volatile that was.
Yeah. Definitely consumer confidence may be affected in the near term. However, with the recent quick resolution of the 12-day war between Israel and Iran has somewhat, initially oil prices went up, spiked sharply, but also came down back to where they were. So hopefully we'll see that more predictable geopolitical environment. Again, I wouldn't be betting on what do you call this? I'll be more cautious again. So I guess this will add more, I guess, to the uncertainty faced by consumers. And for investors, I think the main thing that I'm looking at is that, or the positive silver lining that I'm looking at is that at least the Fed may change their current no rate cut stance to possibly a more accommodative or accommodating stance, and eventually lead to possibly at least one to two Fed rate cuts for the rest of.
And just remains to be seen the timing of those cuts by the Fed, and also how that applies to how the Bangko Sentral decides. He was pretty courageous to actually say at least two rate cuts, even before this inflation figure came out. Do you think he might go for a little bit more after what he's seen today?
Possibly, yes.
Going for 3?
Yeah, because right now we're at 525. Remember, they just did a rate cut in the last meeting that was ahead of the Fed's, even though the Fed did not change their rates. So that for me was a bit bold, and it just showed that the BSP is more confident with regards to the inflationary expectations and the glide path of inflation for the rest of the year. So having said that, I think the two, I agree with BSP Governor Eli Remolona that 2 rate cuts is doable or is in the cards, but I'm not surprised if there will be another one which will further, against maybe surprise the market. And I think that will boost economic activity because, like what I said, in the first half, economic activity was a bit sluggish and behind the government's 6% GDP growth target for the year. And they've recently adjusted it actually. So that means in the second half, we need a lot of catching up.
You're a fixed income guy, so we're going to focus on the bond yields now. There's been a curve flattening, and I've seen that your asset allocation strategy has stayed very diverse, but really skewed more towards, if we can just have a look at this, with the curve flattening, 40% of it in government bonds.
Yes.
How's that going to change now with what you just assessed after today's inflation results?
Possibly increase it to maybe a little more, to 50%, possibly, yeah, and increase duration. And I think right now, if you look at 10-year bonds trading at around close to 6.4%, if you see a 50 basis points rate cut from the BSP and possibly almost the same 1 to 2 from the Fed, then maybe we can see a rally or what you call a further decline in 10-year bond yields and possibly more capital gains for investors. So remember, every 25 basis points rate cut would have roughly about 3 to 4% in terms of capital gains for bond investors, especially in the long end.
Interesting. So now that you're going to pump it up to 50, what happens to the 10? Where are you going to take it from? Is it going to be on the REITs, high dividend, Philippine equities, money market?
Yeah.
Lots to choose from.
Yeah, lots to choose from. But I think maybe the money market T-bills will reduce that further.
How come?
Yeah, because we think the curve is a bit too flat, meaning that we think once the BSP cut rates, then T-bills will be the first to come down, and therefore would rather be in long duration bonds because there's more gains to be made there because the bond prices will be affected, right? So we'd rather get the allocation from money market funds and maybe a tad from Philippine REITs or high dividend paying stocks in the Philippines because we think bonds have a better momentum for the rest of the year.
All right. Well, great. Thank you so much for that assessment. Really appreciate it. And
Thank you,
welcome
Kathy.
back
Thanks for having
to the
me.
show.
Thank you.
PJ Garcia of Grow Capital Partners.